Hey, everybody. This is the Ask Me Anything live on our Facebook groups, LinkedIn, and YouTube. Welcome, everybody. If you guys want to ask a live question, please type it into the chat. We'll try and get through them in the next hour. But for those of you guys new to us, if you guys want to join our group, go to simplepassivecashflow.com/club, fill out the form, and you will get entered into the free intro course that we created. If you guys haven't met me before, my name is Lane Kawaoka. I created Simple Passive Cash Flow podcasts on iTunes, Google Play, and we have a lot of communities where we talk about alternative investing outside of Wall Street, where only Wall Street gets rich and all those commission salesmen. I started investing in rentals back in 2009 and eventually left my engineering job far behind because I was investing in stuff where the Wall Street didn't get rich off my back. So here we go. Got more than a dozen people already showing up. So we'll get right into it because time is money, right? So first question here. Oh, not a question. It's if you got questions, type it into the chat. We're here live. I want to try and get some dialogue going with you guys. But first question, what are the risks of investing in a real estate syndication? So if you haven't heard what a syndication is, it is sort of like a country club deal where people buy a large property in a real estate investment, or you can syndicate anything, really. You can syndicate, I've heard of people syndicating a brewery, different businesses. Just basically it's pulling together investor capital where people are passive investors and there's one or a few general partners or lead investors that are take financial fiduciary of people's money and invest and operate the business. Now the analogy we like to use a lot of times is like an airplane. So in the airplane you have the cockpit with the general partners. The general partners find the deal using their relationships. They get the lenders on board. They get the debt in their name, which is nice for the passive investors. So don't put any of the debt in their name. They are managing. General partners are the managing members that take on the brunt of the liability. They operate the deal. They distribute distributions to investors. And yep, you guessed it, passive investors come into coach. They sit back, relax, cash your checks. And the reason why we use this analogy a lot is because, well, the general partners are incentivized to fly the plane, because if they fly headfirst into a mountain, well, everybody's kind of going down. So everybody's sort of aligned in the same position. But the risks of investing in real estate syndications, I think, lie in people who have never invested in real estate before, right? Anybody can put together a syndication these days. Just get a lawyer and you get working, and you can do it very legally. But do you have a competent, trustworthy person running the deal? A lot of people who are first-time passive investors, if they've never owned rental properties before, they may look at a pitch deck and not really be able to figure out if it's a legit deal at all, or if it's a good deal for the most part. And I think this is where a lot of investors that have owned a few properties in the past, they have definitely a leg up against a lot of other passive investors, even accredited investors, where they can look through a pitch deck and be able to see point holes in the business plan, or see maybe they can run their own comps, kind of look at the analysis and say, no, I'll pass. This thing seems a little bit too aggressive underwriting. And also, those people who have invested in real estate in the past, they have a network of people they can go back and trust. Because a lot of this is like, who can you trust? Who are the trustworthy people out there that are competent and have a good track record? And how do you verify said track record? It's really hard to really prove anything. People can just say, yeah, we own 100, 2,000, 5,000, 10,000 rental properties. Nobody really knows. The only way that I've kind of verified track record is through a network of people that I know that have invested with somebody else in the past, and can, they made money doing it. So I think those are the big risks with real estate syndication. It's really predicated on investing with good, honest people that aren't going to steal your money. I've lost my first syndication deal. I went back in 2013. I lost pretty much all my money. You can read all about it at simplepassivecashflow.com/fail. A lot of lessons learned in it. I didn't know who I was investing with, but at the time I didn't have the network that I had today to be able to kind of make sure I didn't invest with the wrong people. All right, next question here. What questions can you ask a sponsor to understand how they are addressing the risks of the deal? So I have a syndication e-course, and right now I'm doing a little bit of a plug for it, right? It's going to take most people 8 to 12 hours to go through. It is not like another boring book about this. It's pretty interactive. There's a lot of videos. In fact, I think there's 6 hours plus of videos in this e-course. It's really going to tell you what to look out for in a syndication deal in terms of the numbers. There's a whole section on the numbers, which actually I think is the big meat and potatoes of it all. If the numbers are kind of black and white, right? If a sponsor is using a certain reversion cap rate, they're assuming that the rent increases are going to go up, say 3-4% every year. To me, that's a little aggressive, and I would kind of look at the deal with a fine-tooth comb at that point. But there are a lot of other questions that you could ask a sponsor, and there is a full list of 400 something questions you could ask. But this question here, to me, at the end of the day, is a little bit of a trick question. Like, I think you should be able to know if you're investing in a deal before you even look at the pitch deck, because you shouldn't be investing without anybody you don't already trust and verified track record with a peer group of your own. And that's the community that we've created here at Simple Passive Cash Flow. But if there's any other questions, guys, feel free to type it into the private chat. It looks like we have over 14 people have joined us already, and we will move on to the next one here. This one, I think, is a very pertinent question. People are concerned with the interest rates going up because of inflation. Again, inflation is here. It is coming. I can tell you the price of wood is a lot higher than we thought it was going to be 6 months, a year ago. And those people who are just sitting on money, especially in debt equity in their houses that they own, are going to be the losers. The smart money is putting money in things that go up with inflation, such as real estate. And then, unfortunately, the poor people are going to be left behind because they are unable to put their money into things that go up with the pace of inflation. Really sad, actually. But hopefully you guys are smart and you guys are tipped off to this, and you start buying things that go up with the pace of inflation, such as ideally cash flow real estate. So this interest rates are going up idea is something that people are concerned with, for sure. So what I took this article from CBRE and kind of display it. So people are like, all right, you guys are thinking that the interest rate is this, or you lock in these long-term interest rates. Well, what happens when you want to refinance the property, or you need to refinance, get a new loan to pull out equity? What happens if the interest rates go up? And to me, I say, well, that very well may happen. But the fact that the interest rates go up indicate what? Well, it indicates a good economy, that things are going in the right direction. What the Fed does is, when the economy is kind of slowing down, they use the interest rates and they lower it to stimulate the economy. So the interest rates are going up. That's a good sign that also rents are going up. The economy is going in the right direction. So I'm going to share this screen right here. It kind of has a cool slide that I wanted to capture. So I just showed off all my personal information right there. So this is a graph of cap rates and where the interest rates were, essentially. And this one is just capturing office space. I don't know if we want to use office space. We'll just use office space. I mean, office space cap rates sort of dance along with any other asset class, such as self-storage, mobile home parks, apartments. So we'll just go with it. But as you can see, for the most part, they kind of are closely correlated with each other. Um, there's a direct relationship. As the cap rates go down, so the interest rates, and likewise as interest rates go up, go down. I don't know which one leads the other one way or another, but this kind of like proves my point. As the interest rates go up, so do the cap rates, and the cap rates is essentially, in a way, part of it is like it's the market appreciation factor put in. And when I kind of underwrite deals, like I don't assume that the market is going to get better. I actually assume that it's going to get worse. I usually increase the reversion cap rate by 0.5% at least, assuming that when we exit a deal, we're selling it in a crappier market. So call me crazy, but I just feel like that's a prudent thing to do with uncertainty in the future. As with any era, you always don't know what's going to happen in the future. So here's my point, right? Like if the interest rate's going up, that's an indicator that the economy is moving in the right direction, that people are paying their rents, paying higher rents, especially for if you're rehabbing properties, you're increasing the revenue, decreasing expenses, and people have an appetite to pay higher rents. That's exactly what you want going on anyway. So it's kind of like, you're going in one direction. The interest rates ideally isn't the best thing, but if the economy and the market is behind in your tailwinds, it really doesn't matter. And especially when you're using leverage and you're doing force appreciation value add, there's like a much more multiplier effect behind you. And so what, the interest rates go up? Well, because your property is going to be increasing in value so much more quicker at the end of the day. So it kind of sounds like I have a cavalier attitude about interest rates going up, but I mean the math says it all. I mean, if my net operating income can go up, my price of the property is just going to be going up exponentially higher than the interest rates will be going up. People talk about like cap rate compression. Here's what cap rate compression is a negative term, and that's, to me, when the spread between your interest rates and your cap rates are squeezed. And as investors, what you want is the spread times the leverage. That's why we use prudent leverage to juice these returns. And this is just what a bank does, right? I mean, here, 2007, you're paying about 0% for debt, but you're making 6%, right? But then you're multiplying that by maybe a factor of 4 because you're using leverage. That's all investing is at the end of the day. Here, even in 2005, the interest rates were, just call it 2.5%. The cap rates got squeezed at under 6. There's still a spread there. Still makes sense to buy things. Once in a while there's a blip, but it corrects. And this typically there's a correlation again between interest rates and cap rates here. All right, back to the questions. Again, if you guys have any questions, type it into the chat. It'll show up on my screen magically. If you guys have any comments or anything like that, let me know. It gets a little lonely talking all here by myself. And then you guys haven't checked out my podcast, go to simplepassivecashflow.com. For those of you guys who are not accredited investors, check out simplepassivecashflow.com/turnkey for the guide how to buy your first rental property. And that's essentially how I got started. So we had an investor. These are real questions, by the way. How can I join the club? I'm starting with wholesaling, looking to communicate with other investors and be a productive member. Well, folks, if you're looking to wholesale or flip properties or burst strategy, we are not the group for you. I repeat, we are not the group for you. Most of the people in our group are working professionals, more accredited investors. We invest more passively. We don't trade time for money. We don't take more risks than we need to. So if you're looking to wholesale properties, I'm sorry, this is not the group for you. There's plenty of them out there. Google search REI Club and I don't know, go on Facebook. But we're just not that type of community. Question came up. What is daisy chain lending? All right, so if you guys have like started real estate investing and you got caught up in the wholesaler flipper communities, you realize that there's a whole bunch of these like people posing as lenders. And the deal is anybody can get a lender's license and you get access to the screen to sell loans and then apply your certain commission structure or your markup. It's a big market for it. You don't need an office. Anybody can do it, just like anybody can sell a bunch of essential oils, etc. But just something to be aware of because everybody's out there kind of pitching, hey, do you need money? I can be a lender. I'm a lender, I'm the money guy. So it's just, to me, what I would do is just go to more reliable lender, either a larger bank, credit union. Those are where you're going to get your best service and your best rates for the most part, than to go to one of these daisy chain lenders out there. We probably shouldn't. I don't care. I mean, the lenders, they typically don't have very much money and they're not investors in the first place. They're just kind of ancillary players out there. But just know, I mean, you can get a loan anywhere, guys. To me, I would rather work with more of a larger outfit. When we buy apartments, we go directly to the lenders. We use Arbor and Sabal, which are direct Fannie Mae, Freddie Mac lenders. If you guys are buying little single family homes, remote rentals, I have some people I work with. I can give you guys a referral if you guys like. But I mean, there's just a lot of people just daisy chaining this stuff and just marking it up, applying there, and it's essentially like multi-level marketing for the most part. Aloha, Facebook user, for that comment. Yeah, get through the e-courses. Don't get bogged down with them. The remote investor e-course, that should take like 8 hours. The syndication e-course, 8 to 12 hours, depending how, most people watch them at 2x speed anyway these days. All right, so Bitcoin and crypto. So I said in a previous podcast, be careful with what you say on the internet. As soon as you use these keywords, I think you can be targeted because people know that you potentially have a big amount of money in cold storage. So you automatically become a target for scammers. And I have a Facebook group direct, primarily just for crypto investing. Even though I'm not a huge fan of it, I'm always open-minded, trying to learn new things. And as the administrator of that group, I'll tell you what, I see a lot of just shady characters apply for membership, which I swiftly remove, or I have my staff remove them. It's pretty obvious, right? They're like from some foreign country. They got some shady type of profile pictures. You guys know who they are. They're kind of just weird internet profiles. Sometimes it's hard to kind of sniff out the more legit looking profiles doing this type of stuff. And that's why, here's my warning, folks, is like, be careful who you interact out there, especially on free platforms. You pay for what you get, as always. Bitcoin and crypto are very hot topics these days. And then the second thing I wanted to warn people that I've been seeing out there is there's a lot of these like altcoins, right? Bitcoin, crypto, Bitcoin, Ethereum. These are like the bigger, more stable coins. They're not stable coins technically, but they are more stable um, commodities. And if you guys listen to the podcast, the next two podcasts are going to be going into cryptocurrency, which I am definitely bullish on. But I wouldn't put more than 5% of my net worth into it personally at this point. Um, but the altcoins are essentially like startups company. They're high risk, high reward, asymmetric risk type of investments times 100x, in my opinion. I actually don't think like they're so risky. I consider them kind of like securities, and I feel like the average person should not be able to invest in a Dogecoin or whatever these things are. Whatever, there's hundreds of these things. Um, because I feel like people just don't have the sophistication of it. And so what I'm seeing are like there's some of the people, people always apply this multi-level marketing tactic to this type of stuff. And there are groups out there that create a following through search and coin, play the pump and dump game, right? Just get it going, create a multi-level marketing following, preying on people who don't have money, and they're like, you can be rich, you can quit your job, just invest in this altcoin XYZ or whatever it is, right? Because it's just a multi-level marketing thing, the pump and dump. So the founders and the first, second, third rung can get theirs, get out before all the dumb money comes in. So just be careful of these. Like real value comes to those people who create value, which that's what we do. We invest in stable apartments because our tenants pay us rent, and because we improve the communities, make the properties better, they pay us more rent. That is value, right? And I think you have to really kind of question things when you're just buying low, selling high, and you haven't done anything. The wealth goes to people who create value, and to me, when you're just buying and selling things and not adding value, I don't think that that's a long sustainable way of building wealth. Certainly not improving the world in any way, shape, or form. So that's my warning. Be careful of the multi-level marketing altcoin groups out there. Oh, we had a question from Booze. Discuss using SD IRA versus no investments, all where you can't have a QRP and your taxes are too high to cash out. Well, maybe you can retype that one, Booze, but I think what you're talking about. So a qualified retirement plan, I think the ones that you're referring to is it's just a marketing term for a certain type of a solo 401k. Solo 401ks, 401ks, self-directed IRAs, Roth IRAs are all under the umbrella of qualified retirement money, not to be confused with QRP, which is this certain type of solo 401k. So all these qualified retirement money, and just say it out, it's what the IRS calls it, just to differentiate it from the QRP. But the qualified retirement money is money supposedly in a tax sheltered account. You have certain tax benefits, but unfortunately, you don't get the tax benefits when you invest in something like real estate. So here's a great example. Investor invests 100 grand in their qualified retirement money, either from solo 401k, self-directed IRA, self-directed Roth, etc., into a real estate investment. That real estate investment produces passive activity losses or paper losses that are distributed to investors. But because said investor did not invest cash and they invested through an insulated qualified retirement plan money, they are not able to get the benefits of those passive activity losses. And for a lot of people, they may not have things set up. They may not be implementing real estate professional status. I would say 95% of investors have CPAs that just goes right over their head. The CPA, that's a separate issue. But People with I talk to a lot of people, and they may have a lot of money in retirement accounts, right? Because they were good little boys and girls and did what everybody said you should do and maxed out your 401ks and tax sheltered accounts. But when they get to this stage in the game and they start to learn about alternative investments and real assets, they don't have money, right? Ideally, you want to invest cash first, your liquidity, but then they look around and all their holdings are in these tax sheltered accounts, which um, are not ideal to me, and not ideal. And I don't know why anybody would really want to really use these accounts unless they're investing in crypto or something that's not a good tax advantage type of investment. Um, so other things that come to mind are like life settlement investments. You don't get the tax benefits from that, or crypto, you don't get tax benefits from that. So that would be ideal for one of these qualified retirement plans. But the situation where I would use one of these qualified retirement plans is, and this is a very rare occasion, a client has an adjusted gross income of over $330,000 or $330,000 AGI, and has well over a few $100,000 in their retirement funds. And the reason why is because for most people, the name of the game is leaking out your retirement fund slowly so that your AGI doesn't balloon into that highest threshold. To me, when you start to go above $330,000, that's sort of my loose rule of where you want to stay below, because when you go over that threshold, you jump from the 24 to, I believe, the 32% tax bracket. So if you're making 100 grand a year as a family, I mean, no big deal. You're not paying that much taxes. You could probably take it right up to 300 grand, and it's not that big of a deal. But for a lot of our clients, they make above $330,000 AGI. So if they take money out of their retirement accounts, that makes their AGI go up. For example, if they take 100 grand out of their 401k, whatever, and they're already making $330,000 AGI, or 400. Most times it's like $400,000 AGI. Now their AGI is $500,000, and now they're paying big taxes on that amount. So there, I may suggest them looking into a qualified retirement plan, such as a solo 401k or self-directed IRA. But it's a big question. That's why we have the Family Office Ohana Mastermind to kind of help people strategize what to do. And more importantly, talk to 4, 5, 6 other families that have been in the same situation and have lessons learned around this type of stuff, for you to be educated and be able to determine what you should do, so you can have the educated, informed conversation with your tax professional. Again, you need to be the architect of your own financial well-being. To leave it up to somebody else is not only irresponsible, but it is not fair for that tax professional. That's not their job. Their job is not strategy. Their job is to do your taxes for you. Good question. It's always fun when you have questions. All right. Next question here. What does value add mean in syndications? So value add is this this term gets thrown around a lot. In a syndication deal or any type of business plan, essentially what you're trying to do is increase the net operating income, or NOI for short, in a real estate deal or in a business. That is increasing the EBITDA. I think that stands for earnings before interest, taxes, something. You guys can Google it. But essentially, you're increasing the income, the revenue, or decreasing the expenses. So decreasing the expenses could be lowering the utility costs or lowering the salary costs. Increasing income most times means increasing the rents that are being brought in, or it might mean increasing other income, getting some vending machines. Now starting to charge people for reserve parking or trash valet, things like that. So value add in syndications or businesses, I've been looking at some online businesses to buy. I'm not super serious, but just kind of looking at it from the perspective of you're trying to improve the business, trying to increase the net operating income or the EBITDA, and that value add could mean either or. So the question the investors should be asking, that especially passive investors, is to what level of value add is being added, and how is that being done? Is it being with some kind of improvement with management, such as simply asking tenants for more rents? Or is there some business plan or improvement going on, such as, hey, we're going to change out all the flooring, put in stainless steel appliances, with replace those yellow ones? Is it we're going to add some playground equipment, change the signage, improve the online branding of a property? Those are things that cost money, and you guys hear me say it before, but you got to spend money. Sometimes free don't work, or a lot of times free don't work, especially in business. The other business operator would have done it already. So a lot of times it does cost money to make more money or increase the net operating income. So I kind of use a loose framework for like different levels of value add. Light value add would be considered anywhere from no money to maybe $5,000 to $7,000 or less. I think when you start to go to $8,000 to $15,000, now you're talking more medium value add or heavier reconstruction. Maybe now you're changing out in the kitchen some cabinets. Now when you're talking more heavy value add, now you're talking $20,000, $30,000, $40,000 rehabs and above. And we're talking apartments here. Houses are another beast. That's why we don't do houses, because it's just a huge scope every time. House improvements can range from like 50 grand on the light side for like $300,000. And this is why we don't do burrs, guys, because it's a big risk. The more dollars of construction you do, the more uncertainty there is and risk. So that's, we like the business plan of doing the very least as possible. Sometimes in high priced areas, $15,000 may really be a light value add just because of the high priced areas. Something in Las Vegas is going to cost a heck of a lot more than something in Alabama, for example. Ooh, we got a question here. Let's get this question. So Ken asks, this may have been already brought up, but where do you think we are in the current real estate cycle? Always appreciate your insight. So what Ken's talking about is, if you Google like real estate cycle, there's always these cool, very academic graphs of, it kind of looks like a sine curve. It goes up, it goes down. To me, in my opinion, or what I've seen in the past, the fall, it's not always consistent. You're not always going to have like the same amount of difference between the peaks and the troughs. Usually the run up to the peak is a lot longer than the falls. It falls faster than it peaks. But I think normally your real estate cycle, as they teach in textbooks, which not always true, is 8 to 12 years from one peak to another. Therefore, we have much longer gone through our cycle. 2008 was a huge, huge trough. And what we do know is the past performance, what has happened in the past will probably not be an indicator of what happens in the future. So expect the unexpected. But if I was a gambling man, I would probably say we're somewhere in I guess I don't really know. What I do know is that the Fed has pumped in a lot of money, several $1 trillion, I think $4 to $5 to $6 trillion. I don't know exact amount, but that the stimulus that came in this last year makes what they brought in 2008 look like nothing. And we can debate here. Probably we'll go to sleep, and it probably won't matter why that's the case, but regardless, the stock market is propped up on this fake money, and inflation is happening as we speak. So I think the one thing to do is buy properties or buy assets that go up with the pace of inflation. So that cash flow ideally. But if you're a house flipper or you're wholesaling properties, it's important to know where you are in the real estate cycle. But whether you're buying cash flowing properties or going into stabilized assets that already cash flow, to me, it doesn't really matter. Like, it's always a good time to be buying. I mean, it's sort of, I use the analogy of like somebody climbing up a mountain. You don't just like climb, 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 climb. You climb and then you tie off, right? Because should you fall down, you don't die. You just fall off to where you last were. And every so often you tie off again and again and again. So by going into properties that cash flow, should economy go backwards, should we have another pandemic or whatnot, uh, you kind of just fall back on your cash flow and you just continue to keep calm and cash flow on. Um, it's taken me a long time to adopt this mentality, and to me, I think it's the only way to kind of play. Sure, I'm not investing in places like California, Hawaii, Seattle, New York. Um, those are more appreciation based locations. We invest in more boring places, so more for cash flow. And I think a lot of people invest for appreciation, and I've said it time and time again that yeah, it's kind of like shooting a bunch of threes in a basketball game. You win by the three, you die by the three. You win by appreciation, you can make a lot of money, but it sure is you can lose a lot of money. And for a lot of people, especially in our community, it's more about capital preservation. So it's about taking the money that you got through your job, through some lucky appreciation, trading in the chips for some cash flowing investments so that you're hedged to the downside in case a bad thing happens in the economy. So Ken, to answer your question, I have no idea where we are in the real estate cycle. I think a lot of the money has kind of artificially stimulated this thing along. I am kind of bearish on like things happening in the next couple years with residential properties. This is why I'm not a big fan of buying turnkeys right now for people, because I mean, the price of residential properties, because of the low supply, is just pushing up the residential market. And this is why I got out of residential stuff a long time ago, and why I like commercial stuff, because commercial is based on the operating income. Sure, the cap rates have come down, which means prices have gone up due to market appreciation a little bit, but it's nowhere near the frenzy in residential real estate. And I think you're going to start to see the commercial pricing, the cap rates come down maybe a half a point more, which you guys aren't astute. That means that the prices are going to be going up. And I think that's going to happen when you start to see the GDP numbers for the next couple of quarters show 4 to 7% increases quarter after quarter. But that's why I think now is the time to get in, and just in the back of your head, know that you're buying hard assets that produce cash flow. And if even in bad times, can you keep the thing occupied so you can hold on to the asset? What's your break even point? But thanks for the question. Jim here. Hey, Jim. So Jim's question, if you do something like life settlements and have passive losses, it might not be a bad idea to do it through a self-directed IRA if you can take the passive losses. The deferred tax might be more valuable versus a passive loss that is useless to you. I value input on this, and I thought if you disagree. No, I totally agree. If you're doing life settlement investments, and those things don't give you that much return, which kind of sucks, but it's a very stable investments after you're betting on people dying, which is a little morbid. Only for accredited investors. And you don't get passive losses from these life settlement investments. So yes, that is ideal for a qualified retirement plan that you have. So Jim is also saying, in other words, the income later in retirement at a lower tax bracket might be more value versus worrying the use as passive losses now if your income is active now. No. I think I kind of understand the essence of your questions. Here's what I do personally. Like I have a lot of passive activity losses because I invest a lot, and we do a lot of cost segregations. I have a glut of them. I don't know how much I have, but I've been starting to use them up, burn them up to just lower my income today and pay little to no taxes today. Sure, maybe in 5, 10, 20 years, I wish I would have not used up my suspended passive losses, my past losses today. But when I have a conversation with my CPA, we have a meeting of the minds, and we're like, well, he's like, well, Lane, you can probably grow your money faster now today. So I'd rather you not pay taxes and invest the money. And to me, I'm like, all right, well, that sounds fair to me. Let's just go with it. So there's an art form to this, and this is where you have to surround yourself with the right people so you can have, these debates with other sophisticated investors about this stuff. As there is no type of there's no black and white here. It's an art form to this stuff. And exactly to this next person's question here, Biden has proposed changes to 1031, right? So that's just an example of something that might change here in the future. Tax code will change, and tax code typically changes every couple of years, especially probably more officially every 4 years, but like every couple of years there's some guidance paper that comes out on what they meant after the fact, or how you should as a taxpayer should kind of be doing things, or how your CPA should be doing it. But yeah, Biden taking away the 1031 exchange, I don't care. I don't care one bit. Let them have it. Just don't let them take away bonus depreciation and losses, which I don't think they will. People, look, you guys have been investing for more than 5 years. You guys see these headlines are just used to sell headlines. People are like, oh my God, the world is falling because 1031 exchanges will make all these people who have a lot of capital gains sell their properties, and it'll make the whole market tank, and life will be over, and the California fires will like engulf all our houses. Sorry if that was you guys, but some people like act like that, and I think a lot of the media plays to this type of mentality, this fear-based mentality. I honestly don't think that there's too many people out there that have a lot of capital gains. There are a lot of unsophisticated rich people out there that number one, don't know what the heck a 1031 exchange is, and number two, don't give a hoot if they save some taxes by selling now or later. I just don't think it's a drop in the bucket, right? I mean, the people who own real estate that have $1 million net worth and above is such a small amount, folks. It doesn't, I don't think it moves the needle. It moves the needle are people who shouldn't buy houses under $500,000, $1 million worth buying houses. That's what moves the needle. That's the common man. But just to close this question out, I really hope they don't remove the bonus depreciation laws. I don't think that they'll ever get rid of the passive activity losses. That's just a fundamental part of real estate. And I guess it's nice to be on the side or aligned with the people making the laws because they own a lot of real estate. So, but I know Congress needs to pay for a lot of these stimulus plans. So they're looking for ways like this to harvest some of this money. And you know what's the number one way that they can get revenue for the government? Qualified retirement money. That's why you want your money out of that garbage, because essentially the government has a blank check. They have a lien on all your retirement accounts. They can tax that stuff at whatever they want in the future. So therefore, me personally, I took my money out of that stuff, invest cash, because I get the tax benefits by investing in real estate anyway to not pay taxes on gains. To me, that's a no-brainer. Take it out now. By the way, I believe taxes are going to go up. Jim Solomon says, thanks. Facebook user says, have you considered syndicating in storage unit facilities or the constructions of new ones? I've dabbled a little bit as a passive LP partner, but I'll be honest, I haven't found that many good people to work with. I mean, there's all the same ones out there that people do, but I'm not investing in them. But I think this is gets to be like one of the biggest mistakes or common mistakes I see that most new investors get. They come into this world of alternative investing and they're like, "Ooh, goody, like apartments, self-storage, like lions, bears, tigers, oh my," right? And they start to go like ham on all these alternative investments because all the business plans sound amazing and they are amazing, right? You're investing in like really simple, boring investments that make so much freaking sense as opposed to investing in all these like Frankenstein Wall Street products. Yes, it is way better, but what I would urge people to do is like start off with the basics, which is typically apartment investments. And because it is so fundamental and because it's something that you can understand, the reason why I haven't done it yet is because I'll be honest, I don't understand it. I mean, I understand it from a business perspective, P&Ls, but I don't understand all the little nuances, and that's just how I invest until I really get a good grasp on it. I don't really want to put my money in. And so what I would urge people to do is like, put a quarter million, $500,000 into apartments first, and then get a bearing there first before you start to get outside of the realm and start to spread yourself too thin. Um, I get it. People fall in love with this stuff, and they're like, it's a whole new world, like Jasmine and Landon, and they're like, yeah, we want all the colors of the rainbow, all the asset classes. I remember at one time I had like a graphic where it was like Thanos's um, the gauntlet that had the infinity stones, and every color was a certain asset class. And I think maybe people like got too wrapped up in that idea that you had to collect the 5 infinity stones. Had to get one of each. But don't do that, guys. I mean, just stick with one until you feel comfortable enough to go to the other. I mean, get yourself into a dozen deals first before you branch out. Financial planners always recommend investment diversification, says Facebook user. How do you diversify your investments? Well, you guys shouldn't follow what I do because I'm an operator of apartments, so I eat my own cooking. 80% of my net worth is in stabilized workforce style housing that I operate, that I control my own destiny in. Now, for you guys are not operators out there. You guys are passive investors. So what we talk about a lot, I mean, I'm not a big fan of stocks, right? But for a lot of passive investors, diversification is probably what you should do. Like, get some stocks, get some bonds, get some infinite banking, get some alternative investments. Because this is not what you guys do. You guys aren't professionals doing it. And not to say anything bad, but you guys have day jobs. You guys are not spending 2,000 hours a year on this stuff. And it is prudent to diversify. As far as diversification for myself, not all my money is in my own stuff. That's like, somebody investing all their 401k in their company's stock. I'm not an idiot, so that's why I don't do 100% of my own stuff in my own things. But for the 20% of my other stuff, it's more of my speculative bucket where I will go to different asset classes as a passive LP partner. I'm trying to get into the crypto thing a little bit. I'd like to do maybe 1 to 3% to start out, but maybe not more of that. But it's just taking time. I mean, I have limited bandwidth, and I don't want to spread myself too thin to learn. But this is, to me, I'm just going to copy what people in my mastermind are doing. That's my secret for that. Because there's just so much data out there, right? So that's financial planners. I mean, what do financial planners know anyway? Find me a guy that actually made his money, not with, that didn't have a lot of money not with that commission-based product selling to other people. I think we need to roast financial planners more, but that's just me. What is the best way to qualify as a real estate professional without doing bursts or flips? I'm gonna probably do the caveat here. I'm not a CPA, not a tax professional, but what a lot of people do in our family office group, some guys are doing short-term rentals, some guys are getting whimsical flip nearby. Some people are taking more active role in some of these larger syndications, getting the active participation hours up on that. There are a lot of exclusions. There's a lot of things that you can't do that I'm just glossing over the surface, but this is where your network is your net worth. You have to find other people doing this stuff, because if you just Google this stuff, you're just going to find the same old, don't do it. Do it. But people are doing it out there, so you got to find those people and figure out what they're doing. But if I will say, if you are making under $330,000 adjusted gross income, I don't know what real estate professional status will do for you anyway, because you're not paying that much taxes. $330,000. If you're a doctor making $500 or $1 million a year, then I could see where now you can use your passive activity losses to possibly lower your ordinary income. But if you're under $330,000, it will be a little bit of a waste, or as we say in Hawaii, it will be poho to be real estate professional status. But that's what makes it hard out there, right? There's so much like information. How you distill this down, right? And that's what we are at Simple Passive Cash Flow. I kind of take away all the noise from you guys. Keep it simple. But I think that is the run up to the time limit. Unless you guys have any other questions, we will end this talk with, again, sign up for the free intro e-course here, simplepassivecashflow.com/club. There's a form on there to ask any questions too. If you go to simplepassivecashflow.com/question. If you guys are shy, you guys don't want to ask any questions on live. Apparently some people have found a way to be anonymous. Well, I guess we'll never know who Facebook user is, but you guys can ask questions anonymously. Or you can just type it in, simplepassivecashflow.com/question. We queue them up, and then we have the team put it up on these slides for everybody. But yeah, happy investing, stay calm, cash flow on, peace out, have a good weekend, bye.